Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗽𝗶 𝗖𝗽, and I'm joined by my awesome co-host, 𝗖𝗽𝗓 Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Now, our mission is to empower investors to earn passive income through real estate investing. Perfect.
Sorry,
Keep going.
Yes, my bad.
So today we are joined by Chris Larsen. A little bit about Chris. Chris is the founder and managing partner of Next Level Income. Chris has been investing in and managing real estate for over 20 years. Okay. While still a college student, he bought his first rental property at age 21. From there, Chris expanded into development, private lending, buying distressed debt, as well as commercial offices, and ultimately syndicating multifamily properties. He began syndicating deals back in 2016 and has been actively involved in over $400 million of real estate acquisitions. Chris is passionate about helping investors become financially independent, just what we like to hear. Now, August and I believe this interview with Chris will bring great value to anyone who wants to learn how life insurance could be a powerful tool in investing in real estate. This interview will also be helpful to passive investors looking to choose the right sponsor to partner with. So thank you so much for being here, Chris. Welcome.
Welcome, Chris.
Absolutely. I'm excited. And you guys know I'm married to a Canadian, and this is one of my favorite things to do is cross borders here. So this is a real treat.
Oh, fantastic. We're really excited to have you on. Now, if you could just please start off by telling us about your background and of course your start in real estate, please.
Yeah. So as you mentioned, 𝗖𝗽𝗓, thank you guys for the introduction. I've been doing this more than half my life now. So 21, bought my first property in college. And you mentioned the life insurance piece, which we'll kind of go back and touch on that. And my book, which I actually rewrote, and I added chapter 3. I added chapter 3. It's called Your Opportunity Fund. It's all about how we use life insurance to maximize our real estate. If you're listening today, you can get a free copy at nextlevelincome.com. Click on the book link. You can download it, or I'll even send you a copy if you put your address in there. But yes, I was in college, went to school for engineering, and I knew 2 weeks into my freshman year, I didn't want to be an engineer, but it was okay because I was really there to race my bike. I wanted to be a professional cyclist. I started racing when I was 14. And I built my days around my cycling, and it was really formative because a cyclist, you don't make a lot of money. So I was always looking for other ways to make money. And I kind of learned that you could move time around in the day to have the freedom that you wanted to do the things that you wanted to do. And college is great for that, right? You have a lot of freedom that you don't have in a lot of areas of life. So that was, I got to college, I was doing that in between my freshman and sophomore years. My best friend, my training partner, and my roommate in college, Chris, passed away. He had a massive brain hemorrhage and went back to school, raced for another year. I was an All-American cyclist that year. I was state champ. I won a lot of races, and I wasn't happy. I came back to school. I quit cycling, quit racing. So now here I am in my junior year of college. I didn't want to be an engineer. I'm not racing my bike. My team went pro. I quit. So my whole team goes pro. And here I am, kind of lost my friend network. Not really enjoying school. I was depressed. And one day it just, it kind of dawned on me, like, I need to make the most out of every day. Like, I can't live with regrets anymore. And I've got to honor the life that I have and the life that Chris doesn't have. And I mentioned it, as a cyclist, you don't have a lot of money. So I was like, I know you have to have money to be able to have the freedom. I was always kind of entrepreneurial. So that year I started day trading. I started trading the stock market because I had to fill this void of 15, 20, 30 hours a week where I used to ride my bike. Now I have all this time and all this extra energy and brain capacity because I still go to the gym, and I just devoured book after book after book on finances, read online on the stock market, everything I could learn. I read 250 books. So I started day trading. I was making about $5,000 a month as a junior in college day trading. And I was not happy again. I'm here laying awake, at 3 a.m., just thinking like, do I really want to do this for the rest of my life? And I kept searching for other areas of investment. And that's where I came upon real estate and how I bought that first property. It was a townhouse that was for sale right up the road from me. And I bought it, moved in. It was a house hack, rented out the other couple of rooms, bought the place next door, rented those 3 rooms out. So I had my first, kind of like mini 6-unit multifamily property where I rented 5 of the 6 rooms out. And I just moved. I started from there.
And you were still in college at this time?
I was a junior, maybe senior. I bought that second property in college. And I decided, I was like, I'm going to be an investor. I'm going to be a real estate investor. And that was kind of the initial start of that whole process.
Awesome.
That's really cool. And he was making money, day trading with the crypto, making good money. So then you're able to buy real estate with that while you were in college.
Yeah, I mean, and I talk about it.
Sorry, stop.
Yeah. I wish I learned about crypto back then. Man, whew, that would have been, yeah, I missed that boat 20 years ago or 10, 15 years ago. But yeah, so I had, and listen, if you're listening, I had $3,000. That's what it took me to buy that first property. I had my mom co-sign. You don't need a lot of money to get started in real estate. You just do not.
Unless you're from Vancouver or Toronto, then you need $1.3 million to buy your.
Then you need to move, yeah, and then you don't need a lot of money.
That's awesome. Yeah, and I want to discuss your background in engineering, right? Because you kind of mentioned you knew right away, but it's a numbers and data reliant industry. Yes. So you need to be extremely diligent and fastidious to be an engineer. So maybe talk to us about how getting started in that was beneficial to you as a real estate investor, if you will.
Yeah, so it's funny, Ava, because I would go interview and people would be like, okay, so Chris, you have an engineering degree, you have this MBA in finance, and you want to sell like pharmaceuticals, or, I ended up in med device, and people were like, what are you doing type thing. But as I mentioned earlier, I didn't want to be an engineer. I knew that. And I always joke, my counselor pulled me aside and said, Chris, you're not smart enough to be an engineer and you have too much personality. You should look at something else like sales, which is what I ended up doing. But the cool thing, and you really asked a great question, Ava, is you learn a thought process as an engineer. You learn to make assumptions. Excuse me, my light on my phone is on here for some reason. You learn to make assumptions. You learn to question those assumptions. Then you learn a systematized way to solve a problem. So I learned kind of this way of thinking over these 4 years, because every day I'd go home after classes and I would go through this process and solve problem after problem after problem. I learned programming, and I really did not enjoy it, but it just got ingrained in my brain. And what is awesome is it's the exact same process you have to go through when you're analyzing a property. You look at the assumptions, you look at the data, you look at the numbers, you say, okay, can we follow the same systematized process to get a specific outcome within a range? And then can you repeat it? And engineers will say the word iterate. And what iterate means is you try something, you improve on it, and you do it again. You iterate and do it over and over and over again. So that process got ingrained in my brain. And even the fact that I never was a true engineer, I passed the PE, the professional engineering exam. So a lot of people say you were an engineer, Chris, or you are an engineer, but I never practiced, but I still use that process every single time I look at a deal.
That's awesome. So there's lots of good that came out of going through all that. So that's really, really great.
Yeah, absolutely. Engineering, unlike law and other kind of practices, it's like you can't negotiate there. You can't, it's numbers game. It's math, right? So
repetition developed his mind to be really good and utilize that.
Yeah, data. Awesome. You can challenge the data. You can analyze the data. You can look at different things in the data, but the data is the data. Like it is what it is.
A lot of time, like underwriting multifamily deals, where it doesn't, emotion is part of it, but it goes by those data, the kind of the net operating income and all these other metrics that we use in the business and what have you. Great.
Yeah, definitely. And now, Chris, doing a bit of research on your background, we could see you've been involved in investing in multi-asset classes and property types within the real estate asset class itself. Yeah. Now, I have a question for you. What was it in particularly about multifamily for you to have labeled it the holy grail of real estate investing? And furthermore,
Yeah, and
I just really quickly, I believe you started as a passive investor initially. So if you could just touch on that as well, please, that would be helpful.
yeah, absolutely. And yeah, that's the subtitle of my book is using the holy grail of real estate. And yeah, so and I'll touch on all those reasons. So I was working at I became a medical device sales rep. So it's an amazing field. I got to work with these amazing technologies, these amazing, people, geniuses like orthopedic surgeons, orthopedic spine surgeons, neurosurgeons, brain surgeons, right? Like I got to work in the OR with these individuals and be on a team as they did surgery. It was a really cool, rewarding, and also very arduous career where, I mean, I worked 7 months straight one time without a day off. I spent 3 days straight, nights included, in a hospital while I was working on call. I mean, I'd work 40, 60, 80, 100-hour weeks. I mean, I worked a lot. It was financially rewarding, but it wears you out. At the time, I was also managing that portfolio that I built, which is single family properties at the time. So here I'm in my early 30s, mid 30s. I have 2 kids at this point, 2 young boys. And I'm like, man, the last thing I want to do is take a phone call from a tenant or on my honeymoon dealing with the problem. It just wore me down. And I got introduced to multifamily at a meeting with my wife. I looked into it and man, it started to check all the boxes. And for me, again, I'm a data guy. I looked at the demographics and I looked at the ability to control or force appreciation. I looked at the fact that you had income and you had appreciation and depreciation. And then when I looked at the risk adjusted return of multifamily, and this is going back, about 10 years now, had the best risk adjusted return of any asset class. And again, I felt that this was going to persist for another 1 to 2 decades, which we're kind of right in the middle of those 2 decades. And look at how strong it still is. It's just has such demand. So when you added all that up and the ability for me to be a passive investor and make better returns than I was making managing my own single family, I was like, this is a no-brainer. This is the holy grail. I felt like I found the holy grail. So, I started as an investor and did that for a few years. And then as I kind of had conversations with friends. They're like, oh, I'd love to be involved. And my first partner and I, as we kind of analyzed this and talked, and he's an engineer as well, or was trained like I was, we were like, well, look, we have as much or more experience in real estate as the group we're investing with. So we partnered with them, bought our first deal. That's the deal we closed, as you mentioned in the intro, in 2016. So we're going on, entering our 6th year now of active syndicators.
Amazing. I just want to touch on some of those points that you talked about, just to kind of why multifamily is the holy grail in your quote of investing. But just briefly go over it. So you got the cash flow component, you got the natural market appreciation, which multifamily just happens to appreciate better because it's such a sought after asset class. You got forced appreciation. Is going in and adding some form of value add to force appreciate the asset. And then you got depreciation, where you can utilize it for tax purposes. So it hits not only the 2 main fundamentals of real estate investing, which is cash flow and appreciation, natural market appreciation. It's got forced appreciation and tax benefits. So I totally agree with you.
It's the most exciting thing. The holy grail.
And look, let me add one more thing. And again, so my MBA is in portfolio management, and there's a ratio we call the Sharpe ratio, and that's risk adjusted return. So if you haven't heard of this before, the Sharpe ratio, it sounds fancy, and it is fancy. It's a calculation, but it's really just how much of a return do you get based upon the risk that you get out there. And there's something called, I believe it's variance drag, and I might be mixing up the term a little bit, but my point is you're going to get a better overall return in an asset that has an average, say, 10 to 20% range of returns. Like let's say multifamily gives between 10 and 20% range of returns. And I'm simplifying greatly here, right? So the average return is 15% versus, say, the stock market. And again, I'm simplifying. I'm trying to be very, very positive here. Let's say the stock market averages between 0 and 30%. And actually has negative returns.
Negative,
right?
Definitely.
Yeah. But it also has negative returns. But you're actually going to do better over time with that asset class that has steadier returns because especially when the market drops, when it has negative returns, you're going to have a real drag on that portfolio. So I always ask this question when people are like, oh, the stock market has an average return of 10%. It's like, yeah, but you want to know the compounded annual geometric return. That's actually what you get. And that's like, probably if you're listening, you're like, all right, what the heck are you talking about, Chris? That is the actual return, not the average return. It's called the CAGR, compounded annual geometric return. And what happens is it's very simple. Let's say you have $100,000 in the stock market and it drops 50%, right? And then it goes up 50%. You'd say, hey, your average return's 0. You should have 0. You actually lost 25%, right? Because you went from 100 down to 50, back up to 75,000, you're down 25%, even though your average return was 0. And that is why I like to be in asset classes that have a much higher Sharpe ratio, that have less volatility. You're going to do better over a lifetime of investing, even if the average, quote unquote, average return is the same. It's like free returns.
Yes. Absolutely.
Oh,
and I think that the kind of the stock markets, they view themselves as these kind of their returns that they've provided over the years. They don't count the drops and the rises, and they just mention these kind of returns 6%, 8%. But when you do go look at it in more detail, you realize, hey, that is not the case, and it's much lower than that. So
exactly.
Sharpe ratio. That's very cool, Chris. Thanks for sharing.
Yeah.
Now
there's your PhD in a minute right there.
So. Absolutely. I love it. Thank you. Now let's discuss syndication, or as we like to call it here, real estate and private equity. Maybe you could talk to us about your start in private equity and your journey of cultivating relationships and then partnering with investors to acquire multifamily assets.
Yeah. So my start, I kind of mentioned in the beginning, which went from a passive investor to partnering with the group that we worked with to do our first 100-unit deal, which was in the Atlanta market. And then word kind of spread. People were like, hey, what do you do? How are you doing this? When I left my W-2 role recently, it was just like, it really exploded. People were
and when you say the group you work with, you're talking about the operational part of the component, not the group of investors. You're talking about the operation side of it, right?
Yeah. So we'll back up a little bit. Great question, August. So when I first started, it was just myself and one other partner. We did everything. We did acquisitions, we did management, we did investor relations, we did the capital raise, underwriting, everything. And he ended up taking on more of the operation side of things because I was still working a quote unquote 9-to-5 job. Although I worked about 16 hours a day, 6 days a week to manage both my business and my med device career that I was still working on. But we were investing with a group, so a syndicating group. Yeah, so that we partnered up with them to do our first deal, and they were really consultants on that first deal. And my partner and I, we did 5 deals together over the next 3 years. It was. So we bought 5 different communities in the Atlanta market. And then this was about, let me think here, 2 years ago. I guess it was 2 years ago. Lots happened over the last couple of years, but started to expand into other markets in the Southeast. So North Carolina, South Carolina, Florida, Texas. And yeah, so the group I work with has expanded. I've started to move more and more into my own lane, which is, I still do participate in the underwriting side of things, looking at deals, but I've started more and more to handle the investor relations side of things. And, as it's grown, we have over 500 investors now. It's hard you just can't do everything like you can when you're doing one deal a day, 1 deal a year, and there's 2 of you.
100%. Yeah. It takes a big team. It takes a team to manage everying, for sure.
Absolutely. Absolutely.
Yeah.
So maybe we can kind of touch on the next subject here, but I wanted so that the relationship between the general partner and the limited partners, the investors that kind of trust in you to then make the investments, or kind of to bring this whole team together to look at the deal that's being presented by your operating partners, presented the project to your investors. They see you as the steward of their investment, as so on and so forth. So it's a very important relationship, as people are giving investing with you their hard-earned money. But I want to touch on another concept where we're being somewhat introduced to, which is utilizing life insurance to be able to then make investments, make real estate investments on the passive side or the active side. So talk to us about, I believe you're involved. You're actually a licensed life insurance specialist. So talk to us about how this works. What is this comp cent? Because some people listening to this, we did the first time, like, what are you talking about, life insurance? Life insurance is when I go to the bank and they try to push me on this life insurance thing that I always say, no thanks, and I leave. You're talking about life insurance and then utilizing it to invest in real estate. What are you talking about?
Yeah, so everybody listen real close here, because what Chris is about to tell us is a very powerful concept that we're falling in love with it, and we can't wait to share with our network. So please, Chris.
And the rich and the top 1% use, and now it's being available to everyday people. So
yeah.
So look, first off, let me back up and say I put my money where my mouth is. So everything I talk about in my book, everything I talk about today, like I am doing these strategies. I'm investing my money in every deal we do. I'm in the process of starting 2 new policies that are 5 times what our previous policies were with my wife and I. Like I believe in this. And then I also have a very personal relationship with life insurance. So not just because I worked for State Farm 20 years ago. I was a licensed agent back then. When I worked for State Farm, I sold life insurance. And you know what I learned? Buy term, invest the difference. Because you know what, guys, life insurance isn't a great investment. And that's what I heard. That's what I was told. But here's what I found out. And August, you just mentioned this. The richest families, the families that are worth a lot of money, the Rockefellers, that have perpetual wealth, that have money that goes from generation to generation to generation, they're using strategies like multifamily and commercial real estate investing. They're also using strategies like whole life insurance. So if you're thinking, all right, I'm tuning out, Chris just mentioned whole life insurance. First off, I don't want you to think of it like an investment. And here's why. My father died when I was 5 years old. He had life insurance. That life insurance allowed my sister and I to go to college and come out without any debt, partially because of the money he left, which wasn't a ton, but it was enough combined with me working and scholarships to get through school without any debt. Okay. So that's the first thing. The second thing is people are like, oh, Chris, I can get a better return on my money by investing elsewhere. My best friend asked me what I did for insurance. He goes out and he gets policies on himself and his wife. 3 years later, she passes away from cancer. He tells me, Chris, I can't thank you enough. I ended up getting policies for his wife and I was stunned because I didn't know he did that. He just asked me what I did and then went and did it. Well, what was his return on his investment? Like, do you want to ask somebody who just lost their wife that question? Do you think he thinks about it that way? Life insurance is not an investment. It is a tool. Okay. And again, after I heard that story from my friend, I put this chapter in my book. Last year during COVID, I got relicensed because I'm like, this is something that I need to teach people and I need to be able to understand at a higher level. And then if you blend it with the strategies that we're talking about with syndication, it is so powerful. So let me share a little bit more. First off, go to our page, nextlevelincome.com. There's a banking link. We have a white paper. We have a little webinar on there that you can actually see how this goes into play. And if you're listening, if you're into real estate, here's how you can think about life insurance. Term insurance is like renting. So if you've ever rented, you rent, you pay a set amount of money for a year, a couple of years, whatever it is, then your rent goes up, right? And how much equity do you have after your lease is over? Zero. Term insurance is the same. On the surface, it seems like it's cheaper to rent than to own. Okay. And it actually is. It's 30% more expensive to own a home than to rent in the United States on average. Okay. So it's cheaper to rent, but you don't build equity. Okay. Whole life insurance is like owning. It's like a mortgage. You have a set amount of time, 7 years, 10 years, 30 years, 50 years, that you pay a level premium, you pay a certain amount. But the cool thing with whole life insurance, it's higher initially than term, but it just like renting and versus owning, it ends up being less the longer you get into your life. And as you get older in life, it actually doesn't make financial sense to get whole life anymore because the insurance or term anymore, because the insurance companies know you're about to die. So they're going to charge you a lot more because it's just numbers. And I'm an engineer. It just makes sense to me. This is just numbers. But with a whole life policy, you get equity. We have hundreds of thousands of dollars of equity in our policies now after more than a decade of investing. That's money we can access. What we teach, what my partners and I teach and put policies together for is we structure life insurance policies so they grow the cash value, the equity, at a very rapid rate that accelerates the cash value portion. It minimizes the cost of insurance. And this is why, August, when you go to the bank or you go to your financial advisor, they say, hey, August, you need $1 million policy. We're going to sell you $1 million policy. And oh, by the way, you might have some cash value. What we do is we say, hey, August, how much cash value do you want? And we're going to construct the policy to maximize the cash value. And then, oh, by the way, you're going to get this great insurance benefit behind it. It dawned on me when I went to our attorney about 5 years ago, and we were going through our process, and he brought up my net worth. And I was like, wow, that's like 2 times what I thought it was. And he said, well, right here, you have this life insurance policy. And he included that in our family's net worth. And I thought, I just doubled my family's net worth by buying this permanent life insurance policy. And this is what my attorney, who's planning for our future, thought. So look, if you want to protect your family, if you want to increase your family's legacy and net worth, permanent whole life insurance will do that. If you also want to have something that can act as your own bank, that can earn real rates of return, 4, 5, 6%, that you can also borrow against. And we teach strategies to borrow against using lines of credit secured by life insurance at rates of 3 to 4%, very low rates, that you can then invest at 6, 7, 10, 15%. I mean, think about that. If you're borrowing at 3%, investing at 15%,
yeah,
and you're not having to touch your money in your policies,
Yes.
you have 2 pots of money growing at the same time. And it really is. Now there's a cost to it. You're paying for the insurance on the front end, but it takes about 5, maybe 7 years at the most to break even, to pay for that insurance. And then after that 5 to 7 year period, it's 100% upside. So it's like starting a business in that sense, or buying a house. And you get through that initial period, it's a little more expensive, then your equity grows and you're way better off than if you were renting.
Amazing.
Awesome.
Now let's simplify it a bit, just for people to. It's the first time they've.
That was a lot. Yeah.
First time they've heard it. Let's simplify it, and let's use a case study of an investor who approaches your group or our group and says, "Hey, I got $100,000. I want to invest with your groups." But we say, "Hey, hold on a second. There is a way that you could use life insurance to be able to then invest with us." So if they go and buy a life insurance policy for, let's say, let's hypothetically use 130,000 or 150,000 or some X amount of dollar, where it's somewhat reasonable depending on who they go to for the policy. They can actually borrow against that policy the $100,000 that we're going to invest with us, and then they invest that $100,000 with us. Now they get average multifamily passive investing, let's say, gets 15%. They're earning 15% on that investment amount, but their policy, even though the line of credit was pulled against it, the policy in itself is still earning from that initial investment they've made. So
still growing in the bank.
It's kind of a risk leverage that they're using to
arbitrage.
Arbitrage. So
and the thing that blew my mind was, once you invest in the whole life insurance, you put that 150 in, you can borrow that same week. You can borrow against your life.
That's right.
That same week.
Yeah.
So you can literally pull it out that same week, borrow against it, become your own
and
banker.
And you don't have to continuously. A lot of times people get concerned that, hey, if I buy this policy, do I have to keep adding to it? That's another thing about incredible about life insurance, that no, you can just buy that particular policy, even though it does make sense to keep adding to it. But even if you don't, that gives you that kind of leverage that's needed to be able to make.
So you're double dipping your money, essentially.
Yeah, and you guys, I can tell you've seen the light. Like, once you get it, and it's complicated. I've worked with my coaching clients, and we talk through it, and it took me a couple times to hear it and say, like,
same.
Wait a minute. And then, once you get it, you're like, oh, okay. And it is numbers. And so, okay, so let's use your example, August. And I'm going to use round numbers. So you may listen and say, oh, I could do way more than that. Or you may listen and say, that's way too much for me right now. But let's say you're an investor and this isn't uncommon, right? That says, I'm going to invest $100,000 a year for the next 10 years. And that was me. That was my plan 10 years ago. I was like, I'm going to invest $100,000 over the next 10 years. I was making good money, a few $100,000 a year. We were doing development projects. My wife was working. We had the ability to do this. So you start a policy. When you first start the policy, there's that startup cost. If you put $100,000 in the first year, you're probably going to have access to $75,000 to $80,000 of those dollars if you're a young, healthy individual immediately. And again, that $25,000 or 20 to 25%, that's going to go towards the administrative expenses, the upfront cost of the policy, and the insurance. Okay. The policy, then you're going to start growing the policy inside that. So after a couple of years, whatever you put in, if you're putting in $100,000, you're going to get even more than that back in cash value is what it's called. And then I mentioned the 5 to 7 year period. That's when, let's say you put $500,000 in, or 600,000 over 6 years, or 7 over 7. At that point, you're going to have more than that plus, the return, because you're going to have to chip away at that initial amount you put in.
And you've pulled out 75K every year as well, or
no? So here's the thing. You can actually pull out more than that after year one. It's gonna go close to 100 very rapidly. And after typically only a few years, you can do that. So if you say, hey, I want to invest $100,000, if you put it through your policy first, why would you do that? So let's answer that question. Immediately when you do that, if you need life insurance, and let's start off there. If you say, hey, we're married or we have a family, that's a great example of somebody that needs life insurance, right? They want to provide that security for their family. You say, okay, I want to have this policy. You start the policy. If you want to invest $100,000, you're probably going to have to start off with a little bit more than that. But you put that money in, you borrow it out, and now you're freaking out. If you're listening to me, you're saying, wait, Chris, now I got a loan. I had $100,000 cash. Now I have a loan for $100,000. Think like a business person. You have a liability, which is on your balance sheet. And let's say you're borrowing it, let's say 4%. And you have an asset now that you've purchased, a $100,000 investment in a real estate syndication. And let's say you're making 10%. Okay. Is that like, let's just be conservative and say you're making 10%. So you borrow at 4%, you're earning 10%. So you're getting a 6%, real rate of return. But there's something else. That $100,000 you put into your policy isn't touched. It's still growing because that loan is using the life insurance as collateral. So your $100,000 is growing. Like my guaranteed rate of return, or my rate of return on my policy is 5.25%.
Yes.
So it's growing at over 5%, which is even more than the 4% that I borrowed.
It compounds. And it compounds.
So now
yes.
I take the $10,000 from my $100,000 investment. I use 4,000 of it to pay the interest. I still have $6,000 left over. I put that into my insurance policy for the next year, right? To start with that. Now, again, you may be listening and saying, well, Chris, now I'm locked into this. I have to do this. Our policies, we set the pay period for about 7 years. So for somebody that says, hey, I'm going to invest for the next 10 years, you don't have to do that. And oh, by the way, you say, hey, I want to invest $100,000 and run that $100,000 through my life insurance policy, you have a minimum amount. So you can set the minimum amount for, say, 10,000 or 20,000 a year, and then the max for like 100,000, and you have that range. And the thing is, you never have to pay the loans back because it's secured by your life insurance policy. You have flexibility. Now you should pay the interest, but you have the flexibility of when you pay them back. And then you also have the flexibility of how much you make on a premium payment. So what's the downside? Okay. So it sounds great, right? It's like, wait, I grew my money in 2 places. I'm comfortable with the cost of insurance. What's the downside? It's, again, go back. If you're listening to the show, you probably understand real estate really well. When you buy a house, you have a mortgage. Okay. If you have a lease, your lease ends at a year, you can move, you can, switch places, you can move in with your parents. You have to do that. If you have a life insurance policy and you're like, I can't afford to make a $10,000 premium payment every year on a policy, then you shouldn't start that policy. If you say, hey, I have, $100,000 of excess cash, I'm really comfortable having a policy that I can put that into. And I have a business, or I'm a physician, or I'm a high income W-2 earner. Maybe I have some stock options that are vesting and I want to put those into something that's secure and going to be there for the rest of my life. If you have that consistent stream that's coming in, that's predictable over the next, 5, 10, 20 years, you're probably a good candidate to look at something like this. If you're single, if you don't have a family, if you don't have high income, or you have very unpredictable income that you're not comfortable with something like that, maybe it's not a good fit for you.
Right. And what's the penalty if you don't? What if somebody lost their job and they couldn't make that premium that year?
Great question. So what happens is there are options. You can do like a paid up policy, right? So you can stop, pay up. Now your total insurance is going to come down, but there are options for that. And you can even take policy loans to pay your premiums. So if you're like, well, I can't pay them for a year or two, You can take a policy loan. There's a lot of flexibility.
That's cool.
And yeah, you have to really, and again, like if you're working with an agent that puts you in a policy that you can't afford, I would say that's like not a good agent. Like a salesperson that quote unquote sells ice to Eskimos. It's not a good salesperson. Like somebody should tailor the policy to fit your situation and educate you so you don't get into this, situation that you're in over your head.
Right.
Yeah.
And one more thing I wanted to kind of share with people, and correct me if I'm wrong, but these big companies, they've never lost money for people. They're 150 years old between, you know what I mean? And they've never lost money for their investors.
We haven't even gotten into like why the life insurance industry is, in my opinion, so much more stable and just, so great if you think about it. So life insurance has been around longer than the IRS, longer than the stock market. Like it's been around a long, long time. And the thing is, this is just numbers. And, as you guys have been listening, I love numbers. So life insurance companies, if you say, well, how do they pay this 4 or 5% rate of return? If you have a policy with a mutual insurance company, the dividend, it's a return. It's actually classified as a return of premium. You don't pay tax on that, because if an insurance company collects $100, okay, their expenses may be $92, $93, $94, okay? They have to collect more and make more with their investments than they spend. If you're a business owner, you're like, yeah, Chris, that's called a business, right? You have to make more than you spend. They have to do that and plan for this. And they hire and pay actuaries. These are people that study the numbers, hundreds of thousands of dollars a year to do this. They're like the smartest people out there looking at these numbers. So what happens is at the end of the year, they have 4, 5, 6% left over of that, that $100. They have $4, $5, $6 left over. That's what goes back to their policyholders, because they've earned or spent, they've spent less than they've collected and earned and done that. And that's why it's so great. And then these companies, like they've been around and through the Great Depression, the Great Recession. I mean, guess what else they do? They invest in things like commercial real estate, like big Class A multifamily deals and commercial projects. Why? Because these are the smartest people wanting the most stable assets out there. So
nice.
Last question on this topic.
Sure.
That premium you speak of, is that only when you borrow against the policy, or is there a premium charge no matter what? Somebody who puts in $100K, for example.
Yeah. So you have a set premium. So you have a minimum premium payment that you make, and then you have a maximum premium payment that you make. And then if you take out a loan, you have your loan payment, you have your interest. So if you are paying it back, my kind of algorithm for paying back is I pay my interest on my loan because I want to pay that down. I don't want my interest to compound, right? We want our interest on our investments to compound, not on our loans to compound. Mm-hmm. Then I make my premium payments because that's going to increase my cash value in my policy. Then if there's anything left over, I'll make my loan payment after that and start to pay my loan down. So then I have that cash store built up for the future. And it's a whole, it's once you understand the flow and how to set everything up, and that's what we specialize in, is working specifically with investors. Because my agent that I started with, when he heard what I was doing, he's like, that's awesome, Chris. I wish all my clients did that. I was like, why didn't you teach me how to do this? And I said, I'm going to teach people how to do this.
Nice.
What is a premium on 100,000? So somebody gets $100,000 policy. Let's say they pull out $80,000, go invest it in multifamily. They're getting paid 10%. That kind of offsets the interest, what is it called? The loan they've borrowed, and gives them some surplus. But that premium is what I don't understand. No, they have to add a premium, and where does that come into play? And what is that?
Yeah. We're getting into some kind of technical issues. So it depends. Okay. It really does depend, August. So what we would do is, if you said, hey, I'm going to put $100,000 a year into a policy, that would be potentially your premium. And then the face value, the amount of coverage that you get, would be based upon that number that you put it on. So that's where it's backwards when it comes to, like, quote unquote regular insurance, where you go in and they say, hey, I want $1 million policy. What is it going to cost me? We're going to start with the premium that you say you can afford or want to do over a period of time to fund your investments. And then we'll engineer the policies to do that for you. And again, it's going to depend specifically on your situation, your insurability, all that sort of thing. So that's about as clear as I can get without kind of getting into the weeds here.
It's tailor-made to each person.
It absolutely is. And that's why we work with different insurers as well, because different insurers are better for people in different situations.
Really cool stuff, Chris. Yeah,
Great.
thanks for taking the time to explain that to everybody. That's awesome.
Absolutely.
Now, I'd like to just talk about the fact that you're an author, and then, of course, your book, Next Level Income. How did this idea come about? Yeah, there you go.
Tell
we
us
can
more
see
about it.
Yeah,
You did mention a bit earlier,
you already
but
mentioned.
just touch on it a bit more.
Yeah, if you could.
Yeah, absolutely. So, and really, this is how the whole website, Next Level Income, started a few years ago. And like you all, I love what you do. I love that you have this amazing podcast and you share all this knowledge with your audience. And what happened was I had these investments and people were coming to me, and then I'd start to get calls and emails and people say, "Hey, Chris, I can't invest yet, but I want to know what you do, or I want to know how you got to the point where you are, or I want to know how to make more money, or, to get where you are. Like, how did you do it?" And I'd have a phone call, I'd, write an email every week or so. And then every week, it turned into every other day, and then it turned into every day. And I was answering the same emails, the same phone calls, and I cut and paste. And my partner on the podcast initially said, "You should start a podcast." And I was like, "Nah, I don't want it to work." And I thought, well, geez, I'm already repeating myself. Why don't I start taking these concepts and curating them? So I started a blog, I started the podcast, I wrote the book. And then during COVID, like literally right before COVID, got the idea to rewrite the book, add chapter 3, as I mentioned, talking about this, cash value life insurance. And then, it kind of morphed into just tremendous growth of the website and the podcast. And we're on episode 80 right now of the podcast, kind of a slow start. But really the whole genesis of the book, the podcast, and the blog was really to curate and educate the next generation of investors.
Amazing.
That's awesome.
Now going back to multifamily and the topic of multifamily.
Yeah, you have places in Georgia, Texas, Florida, and what's the other regions that you're in?
The Carolinas, North and South Carolina, Georgia, Florida, Texas. I feel like I might be leaving something out in there.
So tell us what interested you about these regions, if you don't mind.
And also, how do you go about choosing the region? Does it come with the region first and the possible operating partners within those regions, or does it start with the operating partners and seeing what regions they're investing in? How does it all?
That is an awesome question. I love that question. If you're listening as an investor, that is like the first question you should ask. So I mentioned I'm a demographics guy, and I talk about in my book how I got into med device because of the demographics. The baby boomers, they're wearing their joints out, they needed surgery. I talk about how my wife and I moved from the DC area to the Carolinas because of the demographics. People were moving here. Guess what one of the top growing states in the country is? North Carolina. It's been growing very rapidly for the past 10, 15 years. We moved here almost 15 years ago. So it's been a while. We moved to where we wanted to live, work, and invest. Okay. I say, you want to live with a rising tide. Oh, by the way, we live in Asheville, which we love. And I know you guys are real lifestyle enthusiasts. Like, you can make it happen. If you're listening, you can live where you want, where you vacation. You can really make it happen. But hey, we live in Asheville. We live in the Carolinas because we thought it was a good place to own real estate. So of course, the next thing we're going to do is look around here for real estate. So I'll tell you what, here's a shortcut, especially if you're in the United States. It's actually a study that's going to come out here very shortly. It's called United Van Lines. And every year they tell you where people are moving from and where they're moving to. If you want to know where you should focus on for your investments, just look at where the moving vans are going this year. Okay. And this probably isn't going to be a secret. They're going to Texas. They're going to places like Denver, Colorado. They're going to like some places in Idaho. They're going to the Carolinas, Raleigh, Charlotte, Greenville, Charleston, Orlando, Tampa, the rest of Florida, Atlanta, Houston, Dallas, Austin. Any of these cities sound familiar if you're listening? Like this is probably where some of your friends are moving, right? Well, that's where you want to invest. Then you want to say, okay, I want to invest in these areas. What area do I want to invest in? Is it multifamily? Is it industrial? Is it commercial office, residential? What is it? Then you find operators in that area and you find out who are best in class, interview operators, figure out how they do things. Does it match up with what you think? Do they have a track record? Do they have a real team? Is it like a solo person that's out there that if they get run over by a car one day, you're out of luck because your distribution stop and you're like, where's my operator? You want to invest in a robust, knowledgeable team that has a great track record, right? So that's kind of the process. Then once you figured out the geography, the sector, and the operator, then you start looking at deals. Too many times, I just had one of my coaching clients email me a deal yesterday. Hey, what do you think of these deals? Do you know this operator? Why do you want to invest in these areas? Right? These are all the questions, that I asked. What is this? Is this the sector of the market that you want to be in? Like, let's back up a little bit, slow down, and then we'll start to look and see if this is a good deal that you should consider investing in.
Great advice.
Great advice.
Awesome.
I love that. Now, before we start our next segment of our show, we just wanted, Chris, if you could please, what advice would you give someone looking to start passively investing in real estate?
Yeah, I would listen to that last segment. And, again, first off, if you're listening to this podcast, you guys have come to a great place. Educate yourself. Think about, hey, okay, I just listened to this episode. Does this make sense to me? Don't trust me. Go say, hey, is Chris, what he's telling me true? Is what 𝗖𝗽 and 𝗖𝗽 telling me? Does this make sense to me? Go test it, look at it, and then start looking at deals. Talk to operators, start looking at deals like you're going to invest. If anybody out there has traded in the stock market, you can kind of have like a phantom account where you phantom trade and see what it's like. Look at deals. See how the operators treat you. Even if you don't invest, see how they respond to you. See if you can look at the track record and the history of those deals. Talk to some other investors, get some recommendation, or get some, other investors that have invested in their experiences. Then once you're comfortable and you feel good, you're going to have to jump in at some point. But that's what I would do for my next steps.
Great advice, Chris.
Yeah. Awesome. Now the next segment of our show.
The 10 championship rounds to financial freedom.
All right.
Whatever comes top of mind, Chris. Here we go.
All right.
First question. Who was the most influential person in your life?
Yeah. So I would have to say my friend Chris, who lost his life, because even though like on the surface, you wouldn't say like, oh, my parents were way more influential. I mentioned my father who passed away when I was younger, but my stepfather and my mother. But the period of time that I had with Chris, and then the value that experience of losing him provided on changing my mindset was absolutely the most influential.
Okay.
And we'll run through these quick because I know we both have to run here.
Yes.
Number 2.
What is the number 1 book you'd recommend?
Well, not counting my book, and this is not a financial book. There's a great book. I just listened to a podcast with David Sinclair and Joe Rogan. It's called Lifespan. And look, if you want, you can have all the money in the world, but if you don't have health and you don't have life, then what good is it? Read Lifespan. You can learn some really cool tricks to not only improve the longevity of your life, but the health that you have during it.
The quality
Right
of life. That
quality. Absolutely.
Yeah. Now, if you had to travel back in time, what advice would you give your younger self?
Oh, I love this one. I use this on my podcast. I can't wait to have you guys on, ask you the same question. Find a mentor earlier, invest in that. And I mean, I spend tens of thousands of dollars a year now on coaching, and I would go back and I would have done that a lot sooner.
Nice.
Yes.
What's the best investment you've ever made?
Well, that'd be coaching. So there you go.
There you go. Now, what's the
Absolutely.
worst investment you've ever made?
The worst investment would be the amount of time I spent with people that have what I would call a scarcity mindset. So if you're struggling, if the people around you, it's like they don't really support what you're doing, and you're like, what's going on here? You need to be around people with an abundance mindset, and
Nice.
don't spend time with people that don't have that. So.
Love it. All right. How much would you need in the bank to retire today? What's your number?
I got it, but how can I answer this question? It's really simple. Like, you need more in passive income every month than you have in monthly expenses. And you don't need a massive net worth to make that happen. If you focus, so my philosophy is, instead of accumulating a bunch of wealth and then saying, hey, I can spend 3 or 4% of this, develop a plan for passive income and allocate your money based upon that. So if you say, hey, I need $10,000 a month to spend, reverse engineer that, figure out what you need to invest in at a specific rate of investment. And that's how you'll get to your freedom number.
Awesome. Okay. If you could have dinner with someone dead or alive, who would it be?
My father.
Wonderful. All right. If you weren't doing what you're doing today, what would you be doing now?
I'm very fortunate that I get to pick everything that I do. But I always say I chose a lifestyle route. I wanted a family. I wanted to have a full life. I wanted to race my bike, ride my bike, live in a beautiful area. But if I went and I listened to the devil on my other shoulder, I would have moved to Wall Street and been a Wall Street trader. And I still think that's like something I think would be an amazing lifestyle to live. It's a lot of pressure, and but I think that would be awesome to experience something like that.
Yeah, super cool.
Yeah.
All right. This is my favorite question. Book smarts or street smarts?
Yeah, you can either read more books or pay people that, like Henry Ford, I think, said, he's like, I have a button on my desk to find the person that has the answer to that question. You can pay people with the right answers. You can't pay people to teach you street smarts. So I'm going to go with street smarts.
Nice.
Awesome. Okay, last question. If you had $1 million cash and you had to make one investment today, what would it be?
I would probably I'd probably spend it on experiences, like travel with the family. Just
Awesome.
yeah. If I had a huge windfall, I would probably invest it, frankly, but I would take a huge chunk of that and just say, all right, we're going to Italy for 2 months, which is in our upcoming plans here.
That's
Awesome.
an investment
Good
too,
for you.
right? That's
Yeah.
some form
Absolutely. Experiences. Hey, you can't take it with you, and we're big on experiences. We love that. So
That's beautiful.
Awesome, Chris. Thanks so much for taking the time. I know you're a very busy schedule. We love what you're doing.
really
we love your
appreciate
book.
it.
And we're sure that this added a lot of value to our viewers and listeners, man. Thank you so much.
Thank you so much, Chris.
you guys are awesome. I love your energy. You guys look fantastic. And I really wish you wonderful holidays here with all the fortune in the world.
Wonderful.